Hey everybody, this is Brett Bonecutter with Monarch Capital on November 20th. Hope you're well. Question I get every day is how are rates? What is going on with rates? And so I thought I'd show you the quick bond chart. You may have heard me talk through this before, but rates are derived from the bond market and from mortgage-backed securities. And it's like buying a stock. They can change minute to minute, hour to hour, day to day. Each one of these lines represents a day over the past 3 months. And as the lines go up, rates get better. As they go down, rates get worse, and that's because bond price, you see these numbers over here, and yield move inversely. So I don't mean to make it too complicated. Bottom line is, if these are going up, rates are going down. So you can see that it's been kind of trending down here for the past 3 months. The past couple weeks, took a little bit of a hit, but bottom line is rates have been trying to claw their way back. Now today, if you just look at today, it's not been a great day so far. Rates have come up a little bit, and again, this is that minute to minute, hour to hour kind of view for you. But the thing that's really important, I think, is to just look here, really over the past year. And what you can see is that we are not at the best levels that we've been at, like we were in the summer. Here, when we were at the absolute lowest, was about almost about a year ago. And then through the summer, we had really low rates as well. But then as we started to get into June, July, things deteriorated. And I don't think that there's a lot of people on the fence, but I think what has happened is people are slow to understand that the rates are just not in the threes anymore. Right now, on a 30-year fixed, you're probably looking at the low fours if you pay some costs, maybe the mid fours to get a loan where your costs are mitigated or paid for. On a 15-year fix, you're going to be in the threes. But in terms of the 30-year fixed type rates being in the threes, that's pretty much gone. That happened back here. Now, that's not to say it couldn't come back. But just to give you some perspective, if we're at 102-ish right now, or 101.3 really, we got to get all the way up to those 106 levels. So almost 450 basis points in the bond market. That means that there has to be a massive shift in sentiment. And I don't know if you've been watching what the stock market's doing, but it has been surging. Now, there are definitely folks who think that that may not last. But the word is that, Janet Yellen, the new Fed chair, is probably going to continue the QE, which is helping the stock market stay fairly frothy. And it certainly helps bonds too, but there is a tension there that I have some other videos about if you want to look for those. But the bottom line is, if you think that rates are in the threes, or if you're waiting for them to come back, I think that's a risky bet. I think that right now things are still historically really good, and if you're in a situation where you can benefit, I'd pull the trigger. If rates really were to go down one more time or again, you could take advantage of that then. But to continue to wait and not do anything, I'm not sure that's a good decision. So at any rate, that gives you some perspective on what rates are doing and where we've been. I hope that helps. If you have any questions, give us a call. Take care. Bye-bye.